We are back again, everybody, with another stock to analyze. And today we are going to be taking a look at CNI. That's Canadian National Railway Company, which, as the name might suggest, is a railroad company with a current market cap of about $59 billion. And it's one of the largest railway companies in Canada. So we're going to start by taking a quick look at the company's financial information, which it released on its earnings in late July. One of the key takeaways that you'll see from this earnings report, as well as a lot of industrial companies' earnings reports, is the word volatility, and that is really the highlight of everything going on for Canadian National, as well as other railroad companies and, like I said, other industrial companies. The uncertain macro environment, aka lots of tariffs, I wonder whose fault that might be, are causing a lot of issues in these industrial companies because imports might be falling due to higher prices. There's a lot of uncertainty leading to imports falling due to businesses not wanting to commit a lot of capital if they don't have to, etc., etc. And these railway companies are obviously directly affected by the number of imports and the number of commodities that are being shipped across countries because that is their job. Their job is to ship these imports. And so finally, before we go check out the numbers, I just want to point out what Canadian National believes will come in their 2025 financial outlook. And they have lowered their volume growth terms to about low single digit growth versus what they expected to be about mid single digit growth, I believe. And that is largely due to tariff impacts and their traffic mix headwinds, as they call it. Basically, the cheaper items still being imported, but the more expensive items not being. And then, of course, they do expect to deliver mid to high single-digit adjusted diluted earnings per share growth compared to 2024. So that is still good. The company is still expecting to grow in that, let's call it 5 to 9% range for its earnings per share. And as you might expect, a lot of that growth will come from incremental margin improvement and, of course, a huge reduction in capital due to share repurchase plans. So before jumping into the numbers, I would like to ask that you all take one moment to like the video and subscribe to my channel, as I am bringing different videos like this all the time for new companies. I'm always looking for suggestions as well for other companies to analyze. So if you have any ideas, leave a comment down below letting me know which companies you would like to see analyzed. And with that, let's get into our numbers. Canadian National has seen some general growth over time. Revenues have grown at about 3.75% per year. EBITDA growing at about 1.85% per year, and free cash flow actually shrinking about 3.65% per year. So this is a company that is not growing a lot. It grows pretty much in line with inflation is the expectation, maybe slightly higher than inflation given margin improvement and technological improvements, things like that. But it's very common for railroads to grow very slowly because they're not a cutting edge technology. They're kind of just working on doing the same job that they have been doing for the last 100+ years. Gross margins have been very steady at about 55%. Operating margins have been somewhat steady, it's currently hovering at 40%, but peaking at 44% in 2020. And the same can be said for free cash flow margins, which peaked in 2020 at 18% and now currently sit at 14%. So at least on the very top line, this company is maintaining its margins. Even in the middle operating segment, it is doing quite well at maintaining those margins through a very difficult time. But as you would expect with a lot of the tariff issues resulting today, free cash flow margins have taken a bit of a hit, but I personally would expect those to eventually rebound. The company has plenty of assets to cover its liabilities, although in the short term we can see the quick ratio is only 0.58 and its current ratio is 0.82, both of these suggesting that at least in the next year, current assets versus current liabilities, Canadian National does have more liabilities than assets, suggesting there is a little bit of a balance sheet issue, but one that I think the company should be able to get through. Interest coverage has fallen sharply, both in part due to lowering profitability as well as increasing interest costs, because following 2020, of course, borrowing rates also skyrocketed. And so EBITDA interest coverage currently sits just below 10 times, which is really solid. And free cash flow covers the interest by about 2.5 times, which is not necessarily great, but it's not a terrible number either, especially for such a large and established industrial company. Canadian National does a great job of buying back its shares, doing so at about 3% of its outstanding shares per year. The company's dividends have grown really nicely. In 2020, they were paying out $1.81 per share, and now they pay out $2.54 per share, which represents nearly 9% compound annual growth over the last 5 years, which is really impressive. But obviously, when we take a look at the free cash flow, that's basically flat from 2020 being $2.74 a share in 2020 and being $2.68 in 2025. So if Canadian National is unable to regain its free cash flow growth soon, we may see a period of time where the company has to either take out loans to pay its dividends out from cash that it keeps on the balance sheet, or pause the dividend increases or even cut the dividend payout entirely to some lower, more manageable number. So definitely something to keep an eye on here. The company does not have a lot of buffer room for its dividend payment. Taking a look at its price to sales, the company currently trades at a 21% discount to its long-term average, which sits at 6.32 times sales versus its current price to sales of 4.97. Its price to earnings also sits at a 15% discount, currently trading at an 18.7 PE versus its long-term average of 22. And its price to EBITDA sits at a 20% discount to its long-term average, currently sitting at about 9.7 times. Now, one thing you might have noticed for all of these is that where it currently sits today is about as low as the company ever gets, or at least in the last 5 years. We've really only seen Canadian National be as cheap as it is today back in 2020. The same cannot be said for its free cash flow, where the company's price to free cash flow is currently trading at 37 times, which is only a 2.5% discount to its long-term average, suggesting that at least on a free cash flow basis, Canadian National is only fairly priced at best. Price to book sits at a 17% discount, and the company's enterprise value to EBITDA, which takes into effect net debt and its market cap, sits at a 19% discount. But of course, once again, when we take a look at free cash flow versus the enterprise value, that discount disappears and it currently sits at only 2%, again suggesting that at least on a free cash flow basis, Canadian National is not expensive today, but it's also not super cheap. But one area you're definitely getting an excellent deal in is Canadian National's current dividend. The company currently yields 2.55%, which is 30% higher than its long-term average of 1.95%. And as we can see, this dividend yield has not been this high more than just two other times. One in April, so kind of the exact same time. You could count this whole stretch of a few months as the exact same time. And then once in 2020. So if you're a dividend investor, Canadian National's 2.55% dividend yield would suggest that the stock is undervalued based on its long-term average dividend. Taking a look at a 10-year drawdown chart, we can also see that this is a very interesting time to be looking at Canadian National. Why? Because the company's current 27% drawdown, which brings it all the way down here, is basically the lowest the company ever gets. Again, April is another example of a time it's been this low, but we should basically count that as the same drawdown event. But other than that, the only other times this company has drawn down about 25-30% is in 2020, where it peaked at 28.5%, and in 2016, where it peaked at 29%. So Canadian National does not tend to draw down very much. It's generally quite a stable company in general, and its drawdowns of 25% plus are very few and far between. And when we take a look at the company's earnings estimates, we might get an idea for why the drawdown is as bad as it is. Because if we take a look at the dark blue line, which represents the company's most recent estimates, we can see it's below the medium blue line, which is a estimate from 3 months ago, which is also then below the 6-month estimate, which is represented by the light blue line. So essentially what we're seeing is analysts getting more and more bearish on the company. Of course, they still expect Canadian National to make a profit. It's just less profit than they had originally assumed. Now, the silver lining here, of course, is that in each one of these cases, including the most recent group of estimates, the fiscal year estimate for 2025 is lower than the 2026, is lower than the 2027. So even though analysts are getting more bearish on the company, they do still believe that over the next few years, Canadian National will continue to grow its earnings per share. So using the implied PEs from the last slide, we can see that Canadian National trades at an implied PE of 25 times its 2025 diluted earnings per share, at 22 times its 2026 diluted earnings per share, and then at 21 times its 2027 diluted earnings per share. So not necessarily cheap on a forward earnings basis, but given how inexpensive the company looks in other ratios, it is probably fair to say that at the very least, Canadian National is fairly valued today. Finally, moving on to the X factors. The first one we always look at is the 5-year expected growth rate, and that sits at a consensus of 8.36% per year for the next 5 years, which is actually very good, given that the company is expecting revenue growth to be only 1 to 2, maybe 3% per year. A lot of that growth, like I said, is going to come from stock buybacks. But as an investor, 8.36% expected growth for 5 years is not bad, especially for a safe industrial company like railroads are. Now, this leads to a PEGI ratio of 1.57, which is, again, fairly solid for an industrial company, especially a very well-established industrial company. And if you're not familiar with the PEGI ratio, that takes the company's price to earnings, the PE part, then divides it by the sum of the company's expected growth and its current dividend yield. So growth plus yield would be the expected total return for the stock. So essentially, we're taking the price you pay for the stock divided by its expected total return to get that 1.57. And the lower the number, the better, because you want your total return to be higher. That same math works for what I call the FG ratio, which instead of taking into account price to earnings, takes into account the company's enterprise value, which is its market cap plus its debt, and then divides that enterprise value by its free cash flow. So if price to earnings takes a look at the company's market cap and its earnings per share, then the FG ratio takes a look at the company's enterprise value and compares that against its free cash flow. So unsurprisingly, we see a much worse number for the FG ratio sitting at 4, which is significantly higher than the 1.5 that the PEGI ratio shows us. Now, I say that's unsurprising because, of course, as we looked at all of our ratios, anytime free cash flow is used, we saw that due to Canadian National's struggling free cash flow numbers, things just looked more expensive. And that's certainly the case here. So a good number for a PEGI or FG ratio is anything under 1. If you can get something between 1 and 2, that's fairly solid. Anything above 2 might be overvalued depending on the industry it's in, the growth expectations, etc. So 3.96, certainly not impressive, but it does look a little bit better when it's next to that 1.57, as well as the 8.36% earnings growth. So to recap, Canadian National is a very solid company. It gets a safety score of 3 because it is one of the safest industries you can be involved in right now. Railroads are very necessary for the transport of specific items that we use every day, all the time. The reason I don't give it a 4, which would be the max score, is because railroads in general are cyclical, just like everything else, especially when commodities, which are generally their main product, are going through bear markets, which many people are expecting to occur if tariffs continue to cause havoc on economies. So railroads, although they are very safe bets, they are not perfect bets, and that's why we get a safety score of 3. And the same can be said for the quality score of 3. Again, Canadian National is an excellent company. I believe it's A- rated, which means it has a very low chance of default. It is expected to be around for a very long period of time, and Canadian National is expected to continue to make plenty of money for a very long period of time. But of course, every company goes through its up and down cycles, and due to the free cash flow margin compression that we've been seeing, I don't think Canadian National warrants a 4 out of 4. Moving down to value, I again gave Canadian National Railroad a 3 out of 4. Why? Well, because the company is fairly cheap on a historical basis. Like I showed you, its drawdown is hardly ever 30%, which is about where it's sitting right now. And in a lot of our different ratios, it was sitting at discounts of 15 to 20%. That's all really good. The reason it doesn't get a 4, though, is because I think on an absolute basis, the company still trades at multiples that are, 17, 18, 19 times earnings, 25 to 35 times free cash flow. And on an absolute basis, you can find other companies that are, equally as undervalued on the short term as they are undervalued against the overall market. So comparing Canadian National to itself and to its railroad peers, I think it does have a really good value here today, but that value is not a steep enough discount for it to get a perfect score. And then finally, I gave the company a 2 out of 3 on the X Factor score. One, for its long-term expected growth of about 8.5%, and two, for its PEGI ratio, which was about 1.5, which for a large, very established company is excellent. Obviously, the company whiffs really big on the FG ratio, again due to that free cash flow number. But I did think it was fair to give the company 2 points out of a possible 3 for that X Factor score. So overall, my final thoughts are that Canadian National is an excellent company. I expect this company to be around a very long period of time. And currently, at least, I will say that it is trading at what I would consider at the absolute worst to be a fair price. So if you're into investing in dividend-paying companies, in blue chip companies that are expected to be around for a very long period of time, they're safer, they're not going to grow like crazy, but they're going to perform over the long term, I think now is an excellent time to take a look at Canadian National. Of course, that is not financial advice, and you do need to do your own research, but we are here to share ideas, and I think Canadian National is a pretty solid idea right now. So with that, please, one more time, leave a like below this video if you learned something, if you enjoyed the video, and subscribe to my channel if you haven't already. I love finding new stocks to analyze, so I'll always have something to throw up on the channel, and if you want to suggest a stock, leave a comment down below. I'd be happy to take a look and try to make a video for it. So I hope you guys all have an amazing day, and I will see you in the next video.